Chapter 1: Information for Decision Making. The term value chain describes a set of activities that transforms raw material and resources into the goods and services that the end users purchase and consume. Let's say you are a furniture manufacturer. You take raw materials such as wood and cloth, and you purchase these raw materials, you cut them up, sew them together, hammer them, nail them together, and you create a piece of furniture. So alone, the raw materials isn't worth that much, but when you perform activities onto the materials, with the materials, these are called value added activities, then your product becomes a good or a service that the end user can actually use. Most people can't use just wood and just cloth and put together their own furniture. So your company takes those raw materials, adds skilled labor, and then creates a final product for the end users. Still going with the furniture example, parts of the furniture manufacturer's value chain might include research and develop research, types of products that consumers are interested in. It can include a design team, which would sketch out new types of furniture designs, and then the purchasing team, which would purchase the raw materials that are needed, the wood, the cloth, the screws, whatever is needed to create that furniture. Then you have your production component, and that's going to be your workers at the factory, the workers with the machinery and the tools are going to produce the furniture that you've decided to produce. And then you have your marketing and sales team, your distribution team, and your customer service team. So all of these teams come together to take raw materials and put them through a process that will ultimately result in a final product that is going to be worth more and that is usable to more end users. One thing to be aware of is the difference between financial accounting and cost accounting. Financial accounting deals with GAAP. Financial accounting creates reports that are created for users that are outside of the company, users such as bankers or investors. They're interested in the financial position and income of the company. On the other hand, cost accounting, those reports are going to be used by inside users, by people inside the company. So the reports are going to be a little bit different. They're more interested in the costs of certain procedures and certain products and raw materials because they want to improve their profitability. There are going to be a lot of similarities between financial accounting reports and cost accounting reports. There's a lot of overlap, but there are going to be some differences based on who needs the information, based on the needs of the end users. This slide shows key positions in a company that you should familiarize yourself with. The chief financial officer is also known as the CFO. That person is going to be generally the main finance person of the company. All of the accountants and HR and payroll are going to answer to him. The treasurer generally manages the liquid assets. Liquid assets are cash or assets that are quickly convertible into cash. A company generally should have enough cash on hand to run the business on a day-to-day basis and also a little bit of cushion. Any cash above and beyond that should probably be invested or paid back to the stockholders or used to improve the business. Cash loses its value pretty quickly with inflation, so it's always a good thing to invest any extra cash, and that's the job of the treasurer to manage that. The controller is generally going to be the main accountant of the business. The controller plans and designs information systems, accounting systems, where he's able to extract information that is needed by upper management. They compile that information into reports and provide it to upper management. The internal auditor or the internal audit team will be the auditor within the company. They look to make sure that whatever accounting policies are in practice, whatever cost accounting policies and any other accounting policies are being implemented correctly. Now, a lot of businesses use external auditors, especially if the business is being publicly traded, then external auditors are engaged. But the internal auditor tries to find any errors and omissions before the external auditor comes. So that way, there are no major financial crises that need to be dealt with. Hopefully, if there are any issues, the internal auditor already caught them. The cost accountant in the company will record, measure, and analyze costs. They play a similar role to the financial accountants in the firm, but their focus is more on information that upper management needs to run the business. So, for example, the cost accountant team might look into certain detail that a financial accountant might not care about. The cost accountant might look at different suppliers of materials, different cost of materials, different ways to ship materials, different marketing techniques, and the costs related to all of those different decisions. Information like that, the financial accountant might not really care about, but the cost accountant will care about and will provide the results of decisions such as those to upper management. Cost accounting is important for managerial decisions. The question is, what adds value to the firm? Cost accountants really look at information that can affect decisions that determine the performance of the organization. So there's a little bit of a difference here between the way financial accountants look at data and the way cost accountants look at data. Financial accountants might look for trends. Maybe they see that a company has been profitable for, let's say, the last 3 years at a certain percentage of profit per revenue, and then they can reasonably predict that the profitability will continue. A cost accountant looks more in depth at the numbers, not just at basic trends, but looks at different aspects, like we mentioned earlier. These are decisions that can affect the performance of an organization and improve profitability. With this cost data, then managers can make decisions. It's the individuals, like the CFO and the controller, that make the decisions based on the cost accounting data that we provide. So it's important for us to provide accurate cost information and relevant cost information. Relevant meaning that they make a difference in the decisions that the upper management is going to make. Now we're going to look at an example of a company, AM Bakery, and how they make decisions. The bakery makes and sells baked goods through a small store. One of the customers suggests that the business expand operations. They want the bakery to sell in the morning and afternoon break times using a food truck. Should the company expand operations? Well, there are a number of considerations to make. They have to look at the effect of certain costs. When you add a food truck, perhaps your utilities and your marketing costs will increase. They increase based on the number of distribution channels. For example, the bakery had a store, which was its one and only distribution channel, and now they're adding a food truck, which is another distribution channel. Also, with the increased number of baked goods that they're making, other costs such as labor and ingredients are going to go up. The cost of labor and the cost of the ingredients should not exceed the amount of revenue and net profit from the food truck. So that's something that they're going to have to estimate and predict. The number of goods produced and sold by the food truck is going to determine how many employees are going to be needed, how much flour, butter, and other ingredients that are going to have to be purchased. It may seem like increased sales is always a good thing, but sometimes it's not. It really depends on how much extra profit is made from the extra sales. So if the food truck increases sales by $1,000, but you have to rent this food truck for $1,500 a month, then obviously that's not a good thing. You might have to increase sales. Now, if you could increase sales to $2,000 or $3,000 and rent of the food truck is only $1,500, then it might make sense. So you have to always do this cost benefit analysis. Differential costs are costs that change in response to a particular course of action. So, for example, let's say you rent a building for $5,000 and it's $5,000 a month every month. Let's say you decide to add a new product to your product line, and this new product doesn't take up any additional space. You can still sell it in your existing building. Well, then that means that it's not affecting your rent at all. You still have your $5,000 rent per month. So that is an example of something that is not a differential cost. Now, let's say that you do need to rent a new building to warehouse your new product. Well, then that is a differential cost, because if you decide to sell this new product, you're going to have to expand the amount of building or real estate that you're renting. So if in a decision it increases an expense, then that means that that's a differential cost. If a decision does not increase a certain expense, then it is not a differential cost. So going back to the AM Bakery example, let's say that the bakery has 5 employees and they decide to swap out one of the items that they sell for a different item. And these employees, the existing 5 employees, don't have any additional work to do. Now they're selling a new product instead of one of the older products. So there's no need to hire any new employees. So that would not be a differential cost. However, let's say that the additional item to be made is to be added on to the existing products that are sold. Well, in that case, the 5 employees that are already working full time, they are going to need extra help. So the bakery is going to have to hire additional employees to sell the additional product. So in that case, the wages and salaries connected to that additional product is considered a differential cost. Differential revenues are revenues that change in response to a particular course of action. So going back to the AM Bakery example, what if AM Bakery decides to expand to that food truck? Their revenues are going to be expected to be larger than if they didn't expand, if they just maintained their one location. The difference between having 2 locations, the food truck and the bakery, versus just one location, the original bakery, will be your differential revenue. Let's take a look at AM Bakery's projected income statement. This is an estimate. These are not exact figures. Column 1 shows the expected revenue and expenses if the bakery decides to stay with its one location. Column 2 shows total revenues and expenses if they expand to include a food truck. And column 3 shows the difference. So this shows that if AM Bakery maintains the status quo and does not expand, then their revenues are expected to be 11,200. If they do expand to a food truck, they expect total revenue to be 16,800. So the difference is 5,600. They expect an additional 5,600 in. Now let's take a look at the expenses. You expect to see, and you do see, increases in ingredients. You go from $2,700 to $3,900. You see increases in labor, in utilities. But let's take a look at rent. Rent for the building is $900. And rent, if you add the food truck, is also $900. So in this case, this rent is only referring to the rent of the original building. You're not going to have to lease any additional buildings or equipment. And so that's not going to be a differential cost. Remember, a differential cost is going to change with a certain decision. So ingredients, labor, and utilities, these increase represent differential costs, but rent, which stays the same, is not a differential cost. Now you look at marketing is going to increase by $50, so that's a differential cost. The truck lease and the truck costs, those are also differential because originally you didn't have these expenses. They were zero because you didn't have a food truck. But now that you have a food truck, you have to pay the truck lease and the truck costs, and those are going to be called differential costs. So we expect to see an increase in sales revenue of $5,600. We also expect total costs to increase by $3,810. So altogether, we expect profits to increase by $1,790. Altogether, that looks like a good thing. So it looks like adding the food truck would be a wise decision. Trends in cost accounting. Cost accounting continues to experience dramatic changes. With changing IT, with developing information technology, a lot of the manual bookkeeping has disappeared, and emphasis on cost control is increasing in all types of organizations. Ethical issues for accountants. Ethics is a big issue for accountants as well as everybody else in everyday life. There's always going to be a struggle with acting ethically. I think we are all born with a moral compass, but we do need to take time to develop that moral compass. Depending on whether we develop our moral compass, sometimes we might make the wrong decision in a certain situation. For example, during college, I worked at Pizza Hut for 4.5 years, and we had a certain time to close every night. We closed at 11 o'clock on most weekdays, and then on Friday, Saturday, and Sunday, we would close at midnight. Sometimes we would be tired and we would want to close. Is it ethical to close early? It might not seem like a big deal, but if we're getting paid to be open for a certain amount of time and we're closing early and still getting paid for it, that's arguably not an ethical act. But sometimes we do make unethical decisions because we have other priorities. Maybe we're tired, maybe we have family to get home to, maybe we have other work or school activities that we need to get to, and so closing a little bit early is what we decide to do. And so sometimes we do make unethical decisions. But it's always good to study ethics to help reinforce our moral compass, and which helps us to make more moral decisions. In the case of cost accounting, we know that the numbers that we report can have a substantial impact on management and upper management in achieving certain financial performance targets. So sometimes we might be under pressure to report certain numbers that we might not otherwise report. And so as a professional accountant, as a manager or a business owner, We face ethical situations like that on an everyday basis. The Institute of Management Accountants, the IMA, along with the AICPA, they've developed a code of ethics that we are expected to adhere. The IMA standards of ethical conduct prescribe the course of action that we should take when we are faced with significant ethical issues. We are expected to discuss conflicts with our immediate supervisor, to follow the chain of command, unless the person committing fraud is our immediate supervisor, in which case we go to the next level. We can get help clarifying the relevant issues and concepts by discussing the issue by calling the appropriate ethics hotline. And we can consult an attorney about our rights and obligations. The IMA's Code of Ethics lists 4 standards: the standards of competence, confidentiality, integrity, and credibility. Competence means that we have to maintain an appropriate level of leadership and expertise by enhancing knowledge and skills. That means that whenever we take on work, we have to be competent. We have to be able to do that certain type of work. And we have to continue enhancing our knowledge and skills with yearly CPE classes to keep our accounting knowledge up. When we perform our professional duties, we're expected to follow the relevant laws, regulations, and technical standards. And when we provide information and recommendations, we're expected to provide those clearly, accurately, and concisely and timely. Confidentiality. As we know, accounting information can be very sensitive. We're looking at the performance of a business. We might look at payroll records. We might know how much salary a certain person is making. All of this information is generally going to be confidential, and it would be bad if this information were disseminated to people who didn't have a need to know. So, as cost accountants, we have a responsibility to keep that information confidential unless we're authorized or legally required to provide that information. Also, when we use someone's confidential information, we inform them of our use of their information, and we monitor our usage to ensure that we comply with the confidentiality rules. And to reiterate, we are not to use this confidential information for unethical or illegal advantage. Integrity. We have the responsibility to mitigate actual conflicts of interest. What that means is, for example, in my job as an IRS agent, if I find myself auditing a company and one of my old college classmates is the CFO of that company, well, maybe I should consider reporting the information to my supervisor and removing myself from the engagement. When we have conflicts of interest, that means that our ability to make neutral assessments of the information might be impaired. So it's best to remove ourselves from a situation that could lead to a conflict of interest or that could indicate a conflict of interest. Number 3 says that we have to abstain from engaging in or supporting any activity that might discredit the profession. So we talked about conflicts of interest. Sometimes there might not be an actual conflict of interest, but if there can be an appearance of a conflict of interest, then it's still best to step away. So, for example, if I'm conducting an audit and one of my college roommates is working for that company, it could be seen that I could be favorable towards that company. I could tell my boss that I won't be favorable, that I'll conduct my audit neutrally and professionally, and I very well could do that. But the fact is, since I already know that person, and if the public finds out that I am conducting an audit of a company where one of my good friends worked, then the public could assume that the audit was not performed neutrally. And so when there's a situation where there can be a perceived conflict of interest, often it's best to stay away from that. Credibility. When we're engaged to perform work, we are expected to communicate information fairly and objectively. We are expected to provide all relevant information that could be expected to influence a user's understanding of the reports. And what this means is we have to use our own professional judgment in determining what may or may not be needed to be provided, what information needs to be provided to the decision makers. If there are any delays in our work, we have to report those delays in conformance with organization policy. And if we have any professional limitations or constraints, we would need to inform the decision makers of these limitations and constraints. So if we are engaged to prepare a certain report or to review certain documents and we don't have expertise in those types of reports and documents, then it's actually our responsibility to not take that engagement. We would need to inform the decision makers that they need to find someone who has that sort of expertise. And finally, this last slide talks about the Sarbanes-Oxley Act of 2002. It's often abbreviated as SOX. Now, this act came out of what happened with Enron and with Arthur Andersen. I started college in 2001, and that's when Enron and Arthur Andersen collapsed. If you recall, Minute Maid Park, where the Houston Astros play, it used to be called Enron Field. They were a very big company, a very big energy company. But it turned out that nobody really knew how they were making money. They did a lot of fancy accounting, and the auditors for Arthur Andersen, which was one of the big five accounting firms at the time, audited Enron, and they didn't understand what they were looking at. They didn't quite understand the accounting methods and the information that was reported by Enron. Instead of trying to find out what that accounting information meant, they didn't want to risk looking stupid or unknowledgeable, so they just signed off on their audit reports. Later on, it was found out that Enron was doing things like capitalizing expenditures. They could be spending money, and instead of reporting those monies as expenses, they would report them as assets. Their balance sheet was way off balance. Their income statement showed way more profit than they really had. And investors lost a lot of money. So Sarbanes and Oxley, who are both members of the U.S. House of Representatives, wrote the Sarbanes and Oxley Act of 2002, which helped to address some of the issues that were uncovered with the fall of Arthur Andersen and Enron. One thing that happened was they saw that the same big accounting firm that was preparing the financial statements also could serve as the auditor of those financial statements, and that was obviously a conflict of interest. So one of the things that the act fixed is now the auditing firm has to be different from the firm that prepares the financial statements, and the firms have to be rotated after a certain amount of years. So keeping that rotation helped to keep things fresh, helped to increase the chances of, if there are any issues, that the issues are brought to light with the rotating firms. And that is the end of the chapter 1 slides.